Okay, we're back again. This is Richard Kossoff with Guaranteed Rate. If you want to reach out to me, it's richard.kossoff, K-O-S like Sam, O-F-F like Frank, at rate.com. Let's talk about the pre-approval process. We already covered the introduction. We got that squared away. You know Guaranteed Rate's a national lender. We got that squared away. What do the banks want when you want to qualify for a home loan? After all, you have a job, you have income, you have credit. Why can't you have the house? Well, you got to think about it or look at it from the bank's point of view. The bank thinks like this. Let's say you want to buy a condo for $500,000. And by the way, a condo is a great place to start. It is a great stepping stone as all property values over time go up. And of course, the barrier to entrance on a condo is less as those prices are typically less. All right, so here we go. You have a condo, it's $500,000. Let's say you put up 5% down. So you came up with $25,000. The bank is coming up with the other $475,000. The bank wants to make sure their investment's protected. And so therefore, having a job and having good credit is a really good start, but the banks need to be convinced. They need to know that their investment on you is safe. And as we talked about before, the higher credit score you have, the better they feel about you paying back your debts. So that's a big deal. Again, annualcreditreport.com. Check your credit, make phone calls to the creditors, see what you can do to improve that credit score. Okay, the pre-approval. We talked about credit now. Let's talk about the next big issue, which is called debt ratios. The banks want to make sure that you only spend a certain amount of your money for a mortgage payment versus the income you make. Any guesses what that debt ratio is? First of all, what is a debt ratio? The debt ratio is if you take all your monthly payments, you take your mortgage payment, your property taxes, the homeowners association fee, mortgage insurance, which we'll talk about. You add all that up, and then you divide it by your income. That's a front-end debt ratio. Front-end debt ratio. Then you take that whole mortgage payment and you add any other debts you may have. Car payments, student loans, credit card debt, monthly payments, any monthly payments. Put those together, divide that by your gross income. Now you have a back-end debt ratio. And the answer is the banks really don't want you to exceed a 45% debt ratio. To keep our example simple, let's do it this way. Let's say you buy for $500,000. And let's say you scrape together 5% of your own money, $25,000, and you get your parents to kick in another $25,000. So you have 10% down. So $500,000 less $50,000, you have a loan amount of $450,000. Current rates, as I'm talking to you, is currently around 7.5%. They're up. 7.5%. The payment on 7.5% is $32.39 a month. $32.39. That's the mortgage payment. That's principal and interest. And if you make that payment for 30 years, every month, that mortgage is completely paid off. I should tell you, if you find another property at another price, you can think this way. Every $100,000 of mortgage today is about a $699, call it a $700 a month mortgage payment. That's for every $100,000. So if you get a mortgage for $300,000, obviously 3 times 700, 714, 2,100, your mortgage payment is $2,100. But that's not the only piece. So we said on this $450,000 loan, we said the payment was about $3,200 a month. Then you have property taxes. Property taxes are based in the state of California at 1.25%. So you would take $500,000 times 1.25%. The next piece is you have a homeowners association fee. Typically, a homeowners association fee runs, if the complex doesn't have a lot of amenities, doesn't have a pool, a tennis court, a spa, maybe it's $300 or less per month. If it has swimming pools, tennis courts, extensive grounds, landscaping, then you're probably looking somewhere more like $450 a month. You also have something called interior insurance on a condominium. Typically runs about $50 a month. That is for Like the homeowners association fee, that covers if anything happens to the outside of the property. The outside of the property has a fire. The outside of the property gets hit by a car. Um, that's the homeowners association covers that with their insurance. But if you have a fire inside your unit, if you have a kitchen fire or a water leak, HOA will not pick that up if it's not, certainly if it's not their fault. So in that case, you get an interior policy called an HO6 policy. That's like $50 a month. When you add it all together, that's about $45.79 a month. Now let's say, for conversation's sake, you and your significant other, or you alone, makes $120,000 a year. That's the easiest way to do it, right? $120,000 divided by 12, that's $10,000 a month. So let's say you make $10,000 a month, and we said that payment was a little more than $4,500. Your debt ratio is 45 something divided by 10,000 is a 45% debt ratio. Banks don't want to exceed that number. So that was just in this example, 500,000, 10% down, $450,000 loan, the mortgage payment, the taxes, the interior insurance, the HOA, and the last category, which I haven't mentioned yet, but was a part of that figure, is mortgage insurance. When you put down less than 10%, the bank wants you to pay an insurance policy to protect not you, but to protect the bank. This is a funny concept. This is, you're paying a fee to protect the bank in case you go belly up. If you stop making payments, the bank gets protected by this mortgage insurance company for the top 25% in equity on the property, roughly 25-30%. So that, with 10% down in this example, is about $132 a month. But again, all added in, the total payment came out to like 45 something a month, divided by 10,000, 45% debt ratio. Now, if you have compensating factors, you have money in the bank, which they call reserves. So you have money, you got money left over after you buy the place. That's a good thing. You got a credit score that exceeds 720. Banks like that. That's a good thing. So when you have these offsetting factors that the banks like, they will go to as high as, say, a 50% back-end debt ratio. Now, in our example, this was just 10% down. You can buy a property with 3% down. When you buy for 3% down, like on 500,000, what is that? 3 5s are 15. That's $15,000 down. The loan would be $485,000. When you do that, obviously, you need to make more than $10,000 a month to get your ratio, your back-end debt ratio, to be 45 or less. When you have less money down, the mortgage insurance company is charging more because, again, they have a bigger risk. If you go belly up, they have to pay more money to protect the bank. So you kind of see what the bank's looking for. Again, offsetting factors are lots of money and great credit. Now, in our example, it was pretty simple because I had either you or you and another making W-2 income. Straightforward W-2 income. The bank doesn't look at your after-tax income. They look at the gross, which was, in this case, 120. What if you're self-employed? I can't tell you how many self-employed people tell me they make $500,000 annually, only to find out after their car expense, insurance, cost of goods, blah, 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 expenses, they bring that income way down to something like $27,000. And the bank, for self-employed individuals, they're not going off the gross top line of gross revenue. They're looking at the bottom line, the net income. So in that scenario, sometimes it is really a double-edged sword for self-employed borrowers because they want to negate their taxes. They want to reduce their taxes, which makes perfectly good sense. So they have expenses, they use those expenses, they whittle down their income, but it makes it harder to qualify. Therefore, a double-edged sword. Anyway, this is the biggest piece for getting qualified. You want the bank to know that your debt ratios are in line. And so the best thing to do is either you can calculate it based on what we discussed, or find another loan officer like me who has lots of experience and get pre-approved. Before you talk to a realtor, go get pre-approved. Richard Kossoff for Guaranteed Rate. I hope you appreciate this topic. Next topic will be FHA loans. There seems to be a lot of interest in FHA, and we'll deal with that next time. Thank you and have a good day.